that you continue there. In terms of inflation, yes, we've been having some challenges in terms of build costs, supply chain, labour, land prices, taxation. For example, one project that we undertook in COVID 2020, the original contract price that we had was about 28 million, and within 6 months it went up to 33 million. I think it's the first time that we have to really account in terms of the financial appraisals of how much contingencies that we need to take into account. 5% build costs is something that seems to be going up and up all the time at the moment. So this comes back to transparency in terms of the family offices that we deal with. We have to explain the additional costs that we will be looking at the same time, put more pressure in terms of the return on investment, the profitability of the overall development, so medium term, long term, which reflects in terms of the residents or tenants that we will be procuring in terms of the projects, because it increases the affordability pressures on the demographics that we will aim for. This seems to be a whole cycle effect, or a whole chain effect, I should say. So there's a lot more factors that we have to consider now, whereas 4 or 5 years ago, before COVID, where it was a lot more straightforward. You could get away with 2% contingency when there was 5% contingency, and they are still sort of putting more pressure, like going down to 17 years before we'll be achieving 22%, 23%. And it's all about mitigating risk now in terms of actually getting projects delivered. So there's some other things happening now. It's the student developers in Manchester, and it took about 6 years of planning for 150 scheme. So much has changed since Brexit, since COVID, and now, so we were built around student accommodation as a class, and well, it seems to be getting stronger and stronger since Trump has taken over, because they're talking about the majority of the students will not be wishing to go to the US now for study. So it's actually putting more pressure into the UK. Whereas in Manchester at the moment, we've got 90,000 students and accommodation only for 35,000. So you can see in terms of the investment yields, it will be more attractive. It's such a hard-working asset class. And so it's all about sustainability, future-proofing buildings, with the higher energy costs and higher interest rate costs. This is something that we have to be transparent with the institutional investors and the private investors of the risks that are going to be, is it sustainable forward? So whereas, for example, the project we connected to the heat district network, and because of that, it's like 30-40% of the discounted compared to the normal energy rates that the normal residents would have to pay. So we're trying to aim for the residents that are more conscious now in terms of energy bills that we'll be paying on the accommodation. And there's a lot more factors that seems to be coming out of the woodwork. So the more pressures that you get, then you have to think more creative in terms of how can we make this sustainable, future-proof, sellable within 5 to 10 years. With the amount of regulations changes and tax changes, and especially when Middle Eastern family offices come into UK, the amount of tax changes that we've had in the last 5 or 6 years, I can't keep up to date with it anymore, as it's continuously changing with the tax advice that we have every 2 or 3 months. And so it's something that I could explain all day long with some of these different challenges and variables.